Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I want to talk about the big warning that Ray Dalio just made on Twitter 5 days ago about the big bubble, okay, the bond bubble, the Fed bubble, which is about to burst. According to Dalio, the bubble which we are seeing in the bond market and also in the stock market is about to explode very soon and is made a big warning over there. We know that Ray Dalio is a macro investor, okay, so he loves macroeconomy. He loves to see what has happened in the past in order to understand what can happen in the long term, in the future. And here he made a very big statement. Also, the fact that the US is risking to actually lose their power as the global currency. Anyway, in this video, I will summarize Dalio's idea and I also gonna give you my opinion at the end of the video. Okay, so the only thing I ask you is please leave me a like. It's very important and I thank you for it, and subscribe to the channel so you don't miss any new updates. Let's begin. So guys, Ray Dalio from Bridgewater, which is the biggest hedge fund in the world, has just made a big warning. We are probably in the latest part of the debt cycle and this Fed bubble is about to burst very soon. Obviously, he refers to the fact that the United States, especially over the last 20 years, has increased their debt dramatically. Here we can see from basically 2012 how it went up parabolically. This is the national debt. Now it is around 29 trillion. And in 2020 alone, the national debt moved from 23.5 trillion to actually almost 29. And as we can see from here, this is the Fed balance sheet actually. We went from before the financial crisis and then the spike of the financial crisis, but since then they were around 2 trillion and now we are very near to 7.5, okay, so almost a 4x in just 12 years. And Dalio, what he's saying about it is simply that why in the world would you own bonds as of now? Because if you look at the developed countries, so first of all United States, Japan, Europe, it doesn't make any sense to own bonds. Simply because if you look at the returns on bonds, they are what he calls stupid. So why the hell should you own bonds if basically the meaning of an investment is to have more purchasing power over the years? But if you buy bonds, it's guaranteed that, considering inflation, the real rate actually is negative. So you are mathematically losing money, and that's a fact. As Dalio points out, in the US alone, if you consider inflation, you should wait over 500 years to get your investment back from bonds. Okay, so that's kind of crazy. But it's the same situation also with Europe and Japan. From this graph over there, we can see the nominal payback period in years. This is in the United States. We have that's just nominal without considering inflation. 1980s. This is where, if you look at the graph of the interest yield of the treasury yield, you had the peak. But then, as we know, 40 years of a bull market because you have interest yields going down. And obviously the price is the inverse of that, okay? So the price of bonds constantly went up for 40 years in a row. And as of now, if you buy a bond, nominal, you should wait at least 60 years to get your money back. If you account for inflation, that line actually fall off the graph, okay? As we can see from here, it will take 100 plus years to earn principal back in terms of real terms. And according to Dalio, especially in the US, this is mainly due to overweighted position in the US bond is largely because of the exorbitant privilege the US has had being the world's leading reserve currency, which has allowed the US to overborrow for decades. The cycle of becoming a reserve currency, over borrowing, and being over indebted, threatening the reserve currency status, is a classic. As part of this cycle, there is the emergence of the currency and capital market of the rising and competing empire. Consistent with the classic cycle, there is now a shifting from US bonds to Chinese bonds going on. Basically, what Dalio says is that if you look back, the history tells you that all the empire, they don't last forever. We have seen that since basically the Rome Empire, then Egypt, Greece, then before the World War II, the UK was huge in terms of the power that they have financially. And then after the war, we have seen the United States took off, basically imposing the dollars at the world's currency, and that allows them to actually become the United States that they are today, printing money basically for free and receiving goods and services from other countries by leaving Asia out of that cycle, okay? And now what Dalio is saying is that this won't last forever. The situation is that the US has raised debt too much compared with the growth of their economy. And now you have emerging markets, especially China, which they have a higher growth potential in economy, and their debt levels are extremely lower than the United States. And what Dalio is saying is pretty simple. Sooner or later, investors will realize that, and what will happen is very likely an outflows of capital. There are some reasons why is that. First of all, as I told you, it doesn't make any sense anymore to invest in those things. Secondly, bondholders, they have had a 40-year bull market. So they are not used to volatility. They are not used to have periods like they happened in the stock market when you actually lose money. For example, 2000 bubble, 2008 financial crisis, or the virus in March, okay? So stockholders are used to that, but bondholders, they are not. And as we are seeing right now with the interest yield that actually touched the bottom and now is pushing back up, remember that the price of bonds is going down. Now, what Dalio is saying is that those guys, they are not able to actually lose value in bonds. And what if they get scared? What if they actually see that they are losing money, so that they want to sell because they don't want to hold that asset anymore? And here it comes something very interesting, because it says, imagine what happens if actually that happens. It's pretty simple. There is now around 75 trillion of US debt assets. And the reality is that, believe it or not, there is not enough cash to actually change all these bonds and debt into real cash if people really start to sell, because they want to get away from that losing money investment. Here is where things becomes quite dramatic, because we could see a run on the bank type of dynamic, okay? And that is what Dalio calls a reverse wave. And when that happens, there is nothing that you can do to stop it other than for central banks, so actually the Fed, print more and more and more and more money. Now, obviously, if you do that, you can imagine that considering the levels where you are already today, well, obviously that will crush the dollar, okay? So the dollar will weaken. Obviously, people will lose purchasing power. They will realize that they don't have that much purchasing power as they thought, and that is bad. And obviously this is a very big issue also for the real economy itself and the stock market as well. And obviously it says that all of that comes from the policies itself. It is the debt cycle, because you start with the monetary policy type 1, which are the most basics one. If you study economics at university, bachelor degree, they're gonna teach you that when the economy is going well, you should put the rates higher. When the economy is in a crisis, you just put the rate down, you increase the liquidity, and then everything is fine. However, after the 2008 financial crisis, that rule doesn't work anymore. Basically, what they teach you at university, it doesn't work anymore since 2008, as we can see from here. Boom! Here it comes monetary policy type 2. Basically, all the easing from the Fed to actually print more money and acquiring bonds in order to increase the liquidity even more, because the interest yield is already near to zero. So it doesn't have an effect anymore on the economy. Now, what has happened with the virus pandemic issue is monetary policy type 3, helicopter money. Because of an issue with the system of financial system, basically, if you continue to stretch those monetary policies, they will have always a lower impact on the economy itself. And you arrive at a time where those money, they actually don't go to who needs those money. So that's why you have the helicopter money, because it's the only way to actually make those money arrive in the hands of who needs those money. And for Ray Dalio, this is the last step of actually monetary policies. So to summarize Dalio's idea, too much debt, bonds don't make sense anymore as an investment. That's fair enough. So people will start to say, well, wait a minute, I don't want to lose my money over time. That is not an investment. So what they do, they start to sell. But when they sell, they realize that there is not enough real cash in order for everyone to sell. If a panic starts in the bond market, there is not real cash, and that causes a liquidity problem run on banks. So people will freak out, and it will be something that, as we have seen basically in the 1950s, and that's very bad. And the major macro cycle for Dalio is made by 3 points. First of all, the credit debt cycle, which is the issue that I have already explained to you. Then obviously when you have the run of the bank and all this kind of stuff, you will have the internal conflict cycle due to wealth, values, and political gaps. And then you have the point 3, which is external conflict cycle due to leading world power, its world order, and its reserve currency, now the US, being challenged by the leading rising power, China. So is this somewhat familiar for you? Well, in my opinion, maybe Dalio has a point over there, okay? And going on in his letter, actually, he describes the pandemic event as the last bomb that actually will make all of that Fed bubble burst, because now it's simply too much, and the pandemic event is what has made the situation actually escalate in an exponential way that now there is no going back, according to Dalio. As we can see from here, the USA budget deficit is now going back to actually the World War II levels. The monetary base is continuing to increase. 2020 has been dramatic. And another point that Dalio says, and it's very interesting in my opinion, and it looks like that is right as well about that if you think about how things are playing out, is that when you print all of that debt in a short amount of time, there will be a time where that debt needs to be repaid. In order to do that, there is the risk of huge increase in taxes. I don't know if that is familiar as well for you. Well, Biden won the election, and now you know that his tax plan is kind of significant. And if he does that, according to Dalio, here is what he says. Based both on how things have worked historically and what is happening now, I am confident that tax changes will also play an important role in driving capital flows to different investment assets, so out of bonds, and especially different locations, mostly in China. And those movements will influence market movements. If history and logic are to be a guide, policymakers who are short of money will raise taxes and won't like these capital movements out of debt assets and into other storehold of wealth assets and other tax domains. So they could very well impose prohibitions against capital movements to other assets, as an example, gold, Bitcoin, etc., and other locations. I don't know if you remember that, but for example, simple enough, delisting Chinese stocks makes sense according to Dalio's idea. These tax changes could be more shocking than expected. Now, obviously, and I am from Italy, so I can confirm you that raising taxes, it doesn't make sense anymore in 2020. Why? Because people that actually have capitals, they don't have any problems to move those capitals across the world. So if you increase taxes, the result you get, you're gonna collect even less money than before, plus capitals, firms, entrepreneurs, all this kind of stuff will go away from your country. That's fair enough. That's why, for example, in Italy, you see that a lot of businesses, they actually went away from the country. You put high taxes, you put a lot of bureaucracy. Simple as that. If you want to make a business, it's way easier to do it abroad than compared to do it in the country. And Dalio is warning that this could happen also in the United States. Once again, favoring actually the move of capital, the outflows of capital from the United States to emerging markets. And then at the end of that, he says that for these reasons, I believe a well-diversified portfolio on non-debt and non-dollar assets along with a short cash position is preferable to a traditional stock-bond mix that is heavily skewed to the US dollars. I also believe that assets in the mature developed reserve countries will underperform the Asian, including Chinese, emerging countries markets. I also believe that one should be mindful of tax changes and the possibility of capital controls. So what Dalios is saying here is pretty strong, but actually makes sense if you look at the bigger picture. We have a huge amount of debt, a bond market which is in a bubble. There is no doubts about it. And if people start to realize that that is in a bubble, they will want to sell. As Dalio says, those bonds are nuclear waste, okay? No one wants those bonds. And the Fed, they will be forced to actually buy those bonds, so create artificial demand for those bonds because there is no real demand. By doing that, you increase the monetary base even more so that the dollar will get crushed. So it's all a cycle, and Ray Dalio says that is about to end. The Fed bubble is about to burst. That's a pretty powerful statement, a very powerful letter wrote by Dalio. I don't know whether he's right, whether he's wrong, but I kind of agree with what he says. However, what I find it difficult, obviously, is to understand the timing of those things, because those cycles, they are actually multi-years cycles. So we don't know whether that will happen in 2 years, 5 years, 10 years, or 50 years. So imagine that the situation will stable again and we will have another 20 years of normality, 30 years of normality. So it's difficult in order to understand the perfect timing of that. But I think that as an investor, it makes sense today to start to think about that. And this is mainly the reason why, if you follow my channel, you know that I have a 13% invested in Chinese stocks. Obviously, it will be even better to actually buy the stocks if you can from the Hong Kong Stocks Exchange, even though as of now it's not very easy. So this is the end of the video, guys. Do you agree with Ray Dalio? Do you agree with Dalio's idea? Probably you think that is too much catastrophic. Can this situation actually continue to last for a long amount of time? Can the Fed balance sheet continue to increase without any problems? Or do you think that taxes and capital outflows and interest yields of debt will continue to increase as people will drop bonds because they don't want them anymore? So leave me down a comment with your opinion. I hope you find the video interesting, and leave me a like if you want, subscribe to the channel, and as always guys, have a wonderful day.